I thought it would be fun to do a Q&A video. Thank you so much for sending in all your questions. There were so many questions, I'm going to do a part 1, part 2, and maybe even part 3 video. So if your question isn't answered today, it'll be in part 2 or possibly part 3. I grouped the questions together by subject. By far, the most questions were about investing. So I'll start with that. There's a lot to unpack, so let's get right to it. The first question is from Deborah Roberts. She says, do you have a financial advisor or do you do your own research? I've met with a few different financial advisors over the years, but I haven't found one yet that I just feel really comfortable with. I don't feel like my money is as important to someone else as it is to me. So for now, I'm just going it alone. I do think advisors have value, especially fee-only fiduciary advisors, and I might use one in the future, especially as I get older. When you're 85, you're probably not thinking as clearly as when you're 55. So at some point, a financial advisor really could add value. The next 5 questions are all basically asking the same thing. How do you invest your money? Okay, so Yvonne Dulaney says, what are your investments? Sean Green says, what are some of the conservative investments you made? Is it bonds and things like that? Liz Lake says, can you share what types of funds, stocks, or investments you keep in each of your accounts? Amy Beauchamp says, how do you decide where to invest your money? And JD asked, if you feel comfortable, would you mind sharing how your money is invested? I am not a financial advisor and I do not give financial advice. I'm happy to share how my money is invested, but please don't take it as advice. You should do your own research before investing. I'm really more of a conservative vanilla kind of investor. Like, my investing is just about as basic as it gets. I think it would help to take a look at my buckets. We're going to take a look at where I started in June and where it was last month in February. So this was over 8 months' time. I show these in my monthly portfolio update videos each month. Jose Rodriguez asks, can you review what a high yield account is? What are I bonds and how is it no risk? And what is an IRA CD? So I'll start with bucket number 1. My I bonds have earned $284 in the last 8 months. They're currently only making about 3%. I need to move that money somewhere else. When I first invested in I bonds, they were making over 9%. I bonds are a type of savings bond. You can create an account and buy I bonds directly through the U.S. Department of Treasury. They're essentially risk-free because they're backed by the U.S. government. A high-yield savings account is a type of savings account that offers higher interest rates than traditional savings accounts. High-yield savings accounts are offered by banks, credit unions, and online banks. I have an online high-yield savings account that was making over 5% at one time. Currently, it's only making 4%. This changes with the Federal Reserve's federal funds rate and the economic conditions. If you Google best high-yield savings rates for 2025, you'll get a list of good options. I did contribute some money to my high-yield savings account in the last 8 months, but the interest rate has been between 4 and 5%. My high-yield savings account has grown by $3,760 in the last 8 months. Some of that was contributions. Now for bucket 2. IRA CDs are zero risk. I just have them in bucket 2 because they're not as easily accessible. You can invest your IRA contributions in CDs the same way you can in stocks, bonds, and mutual funds. IRA CDs offer guaranteed returns, making them an option for people who want a low-risk, steady way to grow their money. It combines the features of a traditional IRA with the security and the fixed interest of a CD. Your account value will not fluctuate and your interest earnings are completely transparent. IRA CDs are considered one of the safest investment options because they're offered by banks and credit unions. So they're insured by the FDIC or the NCUA up to $250,000. If you already have an IRA, you may be able to roll your contributions into IRA CDs. This is what I did. I had an IRA account with Wells Fargo that I wasn't happy with. I'm calling this IRA 1. I rolled $97,500 of it into IRA CDs in February 2024 at an online credit union. I use Alliant, but there's many other places you can do this. If you Google 2025 Best IRA CD list, you'll get a good list. Back when I did this, I got 5.45% interest for 1 year on that first amount I transferred. Then in August, I transferred the rest of that IRA through Wells Fargo. It had $35,900 in it to my IRA CDs. You can see that here. The second IRA CD only made 4.75% interest for 6 months. Both IRA CDs have now matured. They matured at the end of February 2025, and they're sitting in just a basic IRA savings account making 3.1% interest right now. Now I have to decide whether to put some or all of it back into IRA CDs or to invest it somewhere else. The current CD rate is 4.25% for 12 months. The conservative in me wants to just put it all back into IRA CDs. So I rolled $133,400 from my IRA to IRA CDs in total. Now they're worth $140,247. So I earned $6,847, which is about 5.13% interest combined. So back to bucket 2, my 401A is in a total allocation portfolio, a TAP fund. This is pretty conservative. My 401A is 56% stocks and 44% bonds right now. Here's what the breakdown looks like. This is just one of the options I had through work. I think I picked it back in the early 2000s and I've just left it alone. This is the account where I was locked into only contributing 5%. But from June to February, it's grown by $9,715. $1,323 of that was contributions. When I put in June through February online, it says my investment performance was 5.49%. My 403B that I opened in 2018 is a Target Retirement 2025 fund. My 403B is 52% stocks and 48% bonds right now. This changes as you get closer to the target year. Here's what the breakdown looks like. From June to February, it grew by $8,010. $1,500 of that was contributions. When I put in June through February online, it says my investment performance was 6.67%. My 457 deferred compensation plan that I opened in 2017 is also a Target Retirement 2025 fund. Here's what the breakdown looks like. From June to February, it grew by $10,598. I was like, wait, what? When I put in online from June through February, it says my investment performance was 7.29%. So I realized something wasn't adding up. I split my 457 account into my bridge portion and my portfolio portion of retirement. I've been keeping $8,000 of it in the bridge portion on paper. Well, I forgot to subtract that $8,000 starting in January. I was just looking up the balance each month online and putting it on my 3 bucket totals, forgetting to subtract out that $8,000. You can see in December the balance was $22,178. And then in January it was $30,698. I forgot to subtract out the $8,000 in January and February. Boy, I feel dumb. My bad. So really, my February 3 bucket portfolio balance was $503,495. Not the $511,495 I reported. So compared to June when I started retirement, my 3 bucket portfolio has actually grown by $40,895. $35,072 of that was just the growth in 8.5 months. I was still contributing in June, July, and August. Even though I retired in June, I still got paid through August. Teachers get paid to work 185 days a year. They take your pay earned for those 185 days and divide it by 12. So the paychecks we get in the summer are from hours worked during the school year. $500 was pulled each of those 3 months for my 403B. $441 was pulled for my 401A, and I added $1,000 each of those 3 months to my high yield savings account. So in each of those 3 months, I contributed $1,941 to my portfolio. That's $5,823. My February portfolio balance minus my June balance is $40,895. Then I subtracted that $5,823 of contributions. So that equals $35,072 of just growth. Then I used an online calculator to figure out that my portfolio has grown by 8.84% in 8.5 months. So it wasn't the 10.5% that I reported in my last video. Sorry for any confusion, but I'm honestly still really happy with 8.84%. I was just hoping for 7%. Now on to bucket 3. My IRA 2 in bucket 3 is moderate risk. It's called an intuitive investor IRA. My ex-husband and I had 2 IRA accounts that we split when we got divorced. In 2016, the balance for my half of IRA 2 was $49,000. This actually relates to another question. Mommy Business asked, I was wondering if you could share how divorce impacted your finances in retirement. Did you have to share your pension? At the time of my divorce, my ex made more than twice as much money as I did, so I did not have to share my small pension. We were married for 30 years. I could have gotten spousal support since he made so much more money than I did. But I just didn't want to go that route. We have 3 kids together and now we have 3 grandkids, and I just didn't want there to be any tension. We both worked and contributed toward our mortgage while we were married, so in the divorce I got half the equity in our home, which was a little less than $100,000. I put that toward my new home, and I got half of our 2 IRAs. That includes the $49,000 IRA 2 and an $85,000 IRA 1. We each kept our own 401k or 401as. But back to IRA 2, its allocation is 45% stocks and 55% bonds right now. It really shouldn't be in bucket number 3. I need to redo my buckets. Here's what the breakdown looks like. So from June to February, it grew by $5,462. I couldn't put in just June through February on the investment performance on this one, but it says the performance in the last year was 10%. In 2016, when I got my portion of this IRA, it was $49,000. I changed the funds and the risk level at that time. It was just too aggressive for me. In 8 years, that $49,000 has grown to $75,000 from compound interest alone. I haven't added any money to it since 2016. My mutual funds and Roth account in bucket 3 are both aggressive. They belong in bucket 3. My online mutual funds account I opened in 2017. I chose the automated investing robo-advisors option. It's 83% stocks and 17% bonds, which is why it's in bucket 3. Here's what the breakdown looks like. From June to February, it grew by $763. When I put in June through February online, it says the investment performance was 8.4%. My Roth account is 100% stocks. This actually kind of happened by accident, but maybe it's a good thing that it happened. I wouldn't have chosen such aggressive funds because I'm such a scaredy cat. My Roth is one that I opened online. My oldest son helped me pick the funds for my Roth. This was back in 2018 and I was a bit overwhelmed at the time, so I just went with whatever he was saying. But I showed those funds that my son picked to a financial advisor that I met with for an initial consultation, and the financial advisor said, "Those are good ones. I would have picked those. I like your son." so that made me feel better. But my Roth account really tanked between 2020 and 2022, as did a lot of other people's. It slowly climbed its way back, and I'm hopeful it'll do better in the future. From June to February, it grew by $2,786. I couldn't put in just June to February online for this one either, but it says for the last year my investment performance was 12%. I know you should shift toward more conservative investments when you retire. This makes sense to me. However, you need your money to last for decades, so you don't want to completely abandon risk and potential growth. My safe IRA CDs will only make 4.25% interest if I reinvest. That's not enough to keep up with inflation if I pull out 3.5% safe withdrawal rates each year, unless I have more aggressive funds in bucket number 3. Achieving the right balance isn't easy. My personal risk tolerance is really low. It's such a personal thing. I just can't sleep at night if I'm worried about my money. That leads to a couple more questions. Tony Gen X Nurse says, right now the market is looking bad. What is your plan going forward since the market is down? And Mark Ekman says, how did you decide on the level of risk you'll take in your investments? In this video, I shared that I was planning to reallocate to a more aggressive portfolio. Target date funds become more conservative as time goes by. I felt that my portfolio was becoming too conservative even for me. However, with all the projected doom and gloom for 2025, I'll probably hold off for a while on reallocating. I'm just going to hold steady and stay the course for now and see what happens. As far as the level of risk I'm willing to take, I'm just a big worrywart. I'm not comfortable with aggressive investing. That's probably obvious by now. Over the last 8 months since I've been retired, many people have made much more growth than I have. People have left comments saying they made 18% growth or even more. But I'm happy with the growth from my conservative investments. There's over 20 more questions left that I'm not able to get to in this first video, so I'll answer those in part 2 and maybe part 3. Thank you again for all the great questions. If you have more questions, feel free to leave them in the comments. If you're seeing me for the first time, hi, I'm Julie and this channel's Happy on Monday. Thanks for joining me. If you found this helpful, please like, and if you're interested in retiring early, consider subscribing. Today I'm going to leave you with a quote by Winston Churchill. The pessimist sees difficulty in every opportunity. The optimist sees opportunity in every difficulty. Hope to see you again soon.